Do you want your business to grow faster? Are you open to new and out-of-the-box ways to drive revenues and increase value? How do you imagine the most successful entrepreneurs and business leaders double, triple, or expand their businesses tenfold or more? The answer is Deals. This is a weekly podcast featuring conversations with business owners, executives, and leaders as we reveal behind-the-scenes details that give you, our listeners, the confidence to pursue your own deal-driven growth. On the show, we discuss a huge variety of deals, everything from large, complex mergers and acquisitions to smaller deals that you can do even without significant capital. My name is Kupfer, and I've been supporting deal-driven growth for businesses for 35 years as a successful entrepreneur, professional negotiator, and attorney. My goal is to help you strategize, plan for, find, and complete deals that will help your company grow faster. Welcome to the DealQuest podcast. Let's get started. DealQuest Community, I come in every year, and at the end of the year, sometimes mid-year, we'll do these recaps of what's going on in the deal market based upon our experience, because we do so many deals, what we're hearing from other people in the marketplace, and also, what is reported in some of the press. So I'm recording this in July. I think it'll get released either later this month or maybe early August. But we're going to look back at the first 6 months of 2023. And particularly what's been happening in the last quarter, because, for a while we've been talking generally about how there are these different factors, right, that are affecting the deal market. There's, in various industries, including the financial services space, where everybody who listens to this podcast knows we do a lot of deals. There are medium and long-term trends that are very, very positive, especially in the wealth management space. Obviously, tech, there's a lot of innovation still going on there, and, that it runs in cycles, but there's always huge opportunities in tech, which is another sector that we have a lot of clients in. And frankly, we've done deals in, you name an industry. And obviously the things we're going to talk about, you have to look industry by industry, geography by geography. There's no single deal market, but there are trends that generally apply across most sectors in most places. And, it's interesting to look at them and at least be informed by them and, understand a little bit what's going on right now. So there's a few things that were recently in the press. For example, there were some articles about PitchBook, which came out with some new data. They do data on the venture capital funding. And in the second quarter of 2023, they recorded about 3,000 deals that were booked, which is down about a third from a year earlier. So second quarter 2022, the deals were one third, higher than they are here than they were in 2023 second quarter. And also the amount of investment was down about half. So not only is the deal volume down, but the investment amounts obviously are going down as well. The biggest drop, they say, was in angel and seed deals for companies in early stages. And that's not surprising in markets where cost of capital has gone up, where the risk analysis of investors in an uncertain economy. It's very interesting with this economy. There are people who feel like it's going very well. There are people who say we're in a recession. There are people who say maybe we're heading towards a recession. It's sort of a very mixed view of exactly where we're at overall. And I think it depends upon what you're looking at and where you're at and how it's affecting your industry. But in any case, it's certainly an uncertain market, some challenges. And, in those kind of markets, the riskier deals, the earlier stage deals are the ones where the money pulls back from first, right? There's a move of money to, quality deals. And I don't want to say the early stage deals aren't quality deals. They're just riskier deals. So that, so let's say, deals that have maybe a higher opportunity of return, a little more level of certainty, certainly not the word in the venture capital market because most fail anyway, but, a high level of chance of success, at least, some more proven track record and things like that. So that's not shocking in this market. They also cite that globally venture capital funding was down 48% in the first 6 months of the year. And that's according to Reuters, which attributes mainly to two factors. One is higher interest rates, right? Cost of capital. We all know that's been a significant factor as the Fed has pushed up interest rates significantly. Again, when I say this, I always try to put it in perspective because historically, interest rates are not unusually high right now. They're kind of, in the middle of where they've been historically, but it's just that interest rates were so artificially low for so long, and then they were pushed up so quickly that, things have to be re-underwritten, repriced, And, the market hasn't fully adjusted yet. So higher interest rates is one factor. And the other one is an IPO drought. And, we've had some, not clients, because we don't do IPO work really, but we know of people in some various industries, companies in some various industries that have considered going public and have pushed it off or even filed and then pulled it. So yeah, there's definitely a drop in the IPO market. Now, they maybe not shockingly for anybody who is, breathing practically, but they say the one bright spot for is one sector, which is AI, where $40 billion were poured into AI startups over the last 6 months, over the first 6 months of the year. Again, with the popularity of things like ChatGPT and it becoming a mainstream conversation about AI, I know an entrepreneurs organization where many of you know I've been a member for a long, long time, and it's a worldwide organization of entrepreneurs at a certain revenue level. There's AI groups on it, all about chats. There's all kinds of stuff. People are talking about it. So obviously that's a hot sector, and that's an example of where even if things are going in a certain direction in the overall market, like for example on the investment side, right, in venture capital funding, that any given sector could be very countercyclical, and certainly AI is the hot one, the biggest hot one now. So that's where a lot of money is going. And in those sectors, obviously, because it is so new, I said earlier about there being a pullback largely on the seed and early stage side. That's clearly not as true or not true in the AI sector, because almost everything there is in seed. I'm exaggerating slightly, but for the most part, they're relatively early stage. There aren't that many established companies in the AI space. So that's definitely a countercyclical thing. So that's some information on the VC side. Let's talk a little bit about the M&A side. So there was another interesting article that talked about global mergers and acquisitions in the second quarter. And this came out of Reuters. It was reported in Reuters. And M&A activity globally fell 36% year on year in the second quarter. So again, comparing Q2 2023 to Q2 2022. So, that's a pretty significant drop, not as significant as the drop in VC investing overall, but 36% is a real amount. The total value of M&A fell to, they say, 733 billion in the second quarter from 1.14 trillion in the second quarter of 2022. So, that's a drop. That seems to be, I haven't done the math exactly, but that seems to be roughly in the same 36% range as the amount of deal volume. So unlike in the VC space where there was a drop in investment that was higher than the drop in deal volume, so investment levels went down, it seems like deal sizes are staying relatively the same, that just the volume has dropped. And, again, keep in mind, we're talking about global M&A that's tracked, and a lot of times the smaller deals don't get picked up in these kind of statistics, right? They focus on the bigger deals, public company and large private company deals. They also got some input from investment bankers and lawyers in terms of, what they see going forward in that area. One of the things they reported on was that they say that investment bankers and lawyers expressed optimism that the stock market recovery would gradually restore, chief executives' deal-making confidence. And, makes sense. I mean, the market seems to maybe be, getting a little stronger after a lot of uncertainty recently. And, certainly on the public company side. And listen, whatever happens on the public company side, even though the private large company, private middle market, and certainly private smaller to medium-sized deals and Main Street deals don't track exactly, the level of confidence and things does flow down, right? It is instructive in some ways. So there seems to be some optimism there with hopefully the market firming up. Also, the investment bankers and lawyers that were interviewed said that there's a more challenging environment for leverage buyouts, making acquisitions difficult for private equity firms. And that makes sense as well, because leverage buyouts are leverage, right? They're done with a lot of debt, which means that, the cost of capital makes a difference in those kind of deals. Private equity-led buyout volumes slumped 59% year on year. So that's for the first half of 23 versus 2022. In the second quarter, sponsor-led buyout volumes fell 56%. So these are significant numbers. And, for a while there, we were saying, even when the economy was a little shaky last year, that there was so much money that needed to be deployed that deals were still happening. And that was true then, but now things have definitely, slowed down. And despite the fact that there's still capital out there, it's being much more judiciously allocated. And, I've also at least heard anecdotally, I haven't seen statistics on it yet, but I've heard at least anecdotally that some folks are not, rushing to or have a little more challenge in raising new funds. So while as they still have capital maybe to deploy in the existing funds as those are closing out, they may not, be raising as much or as quickly in a new fund. So, there's also a little bit of a discussion on valuation adjustments, right? And, sort of like having the market adjust and accept for that, which makes sense. I've talked about that before. They also raised, whether the regional banking crisis, the issues with some of the regional banks that came up in the last, 6 months have adversely affected. And it's not been significant, but there are potentially some ripple effects on, broader credit availability that may affect that.
Let's take a break from the show for a minute so I can invite you to a new way to determine your deal readiness. I created a fast and easy assessment that will determine exactly how deal ready you are. Once you complete the assessment, I use your responses to identify the obstacles that are holding you back from being a deal-driven growth genius. It's as easy as heading to CoreyKupfer.com/assessment. That's CoreyKupfer.com/assessment and filling out a few multiple choice questions. I'll be checking in after the episode to see what your results are. Now back to the show.
The other thing that's interesting that they raised here is that there's really been no mega deals like, in the transactions of 25 billion and above. And there haven't been, as many of those. So obviously, those big top end deals pump up the stats and there's been fewer. There's also less credit available to the middle market, which again is not surprising, and to commercial real estate, which, is often heavily funded by these types of investments and funds. And that has been affected. Interestingly, I spoke to somebody recently, and again, this is one person. They're a real estate professional in California, in the LA area. So they weren't only talking about their personal experience, but what they think the market is there. And I've heard similar things that they said the commercial real estate market in the LA area overall is down about 40%. I haven't confirmed those stats, but that's what I heard from one of my real estate connections here in the LA area. And that's on the commercial side. Residential is a different conversation out here in LA, especially where we are by the water. But that's a different conversation. But the commercial market is down. In fact, this particular guy picked up a warehouse at 50% off of what it was valued previously, and thinks in the long run that's going to be a great investment. So that raises the other thing that I've repeatedly said is that some of the best deals turn out to be deals that are done in these kind of down markets. Obviously, they may be more difficult to finance, but if you have access to capital or have your own capital, available, things are on sale, so to speak, and there's always good opportunities that people take advantage of there. So that's most of what I saw in this Reuters article and some thinking about around that. Interestingly, in the wealth management space and the RA space, which you all know we do a bunch in, Fidelity came out with a report recently on RIA valuations. Now, this is an interesting report because it's a lot different comparison actually than what we've been talking about here. In most of the other areas, I was comparing the first 6 months or the second quarter of this year to the second quarter of 2022. Fidelity did a study that compared the 2017 to 2019 3-year period with the 2020 to 23 period. And not surprisingly, because this particular area has just so, the volume of deals, the valuations, everything has gone up just because the market is so maturing and because of the number of private equity firms that have come in that period, right? Post 2019, or maybe they were late, in that 3-year period, but certainly into 20 to 23 here. And some of the stats they've given there are that median EBITDA multiples for firms increased from 7 times EBITDA to 9 times EBITDA. So that's median. We did deals as high as 14.5 times EBITDA at the end of last year. So these are multi-billion-dollar firms, or actually $1 billion plus. It's called $1.5 billion plus. We're seeing numbers more in the 11, 12 times, EBITDA for those kind of firms these days. And the 14.5 was a pretty top dollar deal. We had other ones that weren't as high last year. And then in the smaller firms, maybe we're seeing the 7s go up to 9s, or the real small firms, the 6s, 5 or 6 goes up to 7 or 8s. What the view is that we sort of hit a plateau on valuation. I think that's certainly the case, and we've seen it dip down. And there's a couple of factors that go into these deals. It's obviously the valuation, like anything else, right? The multiple, but then it's also what it's based upon. And obviously, with the stock market being down, the fact that advisors make their money mainly on a percentage of assets in the management. So when the market's down, their revenue is down. So you have a lower multiple on a lower base. So your purchase prices have come down, although in many of these deals, there's earnouts and similar provisions that will allow a lot of these advisors to catch up and make that additional money if the market does come back. In terms of deal volume, it's really interesting in this space on the comparison of those years. Fidelity's reporting on 146 deals during the 2017 to 2019 period, whereas they counted 492 reported transactions in this 3-year period, 20 to 23. And again, these are reported transactions. Not every deal gets reported, but you can just get it, just the nature of the difference, right? We're talking about almost 3 times the amount of deals, the number of deals. So the median assets in the management of the acquired firms increased from 250 million to 400 million. And again, we do a lot of our deals. We certainly do tuck-in deals at that size, the smallest size. The reason that's skewed down, remember, that's not an average, that's a median. So that includes, a number of the small books of business kind of sales, and then bigger deals that we've done where clients are doing anywhere from 10 million to 100 million in purchase price. Those deals skew the median up, but because there's a lot of smaller deals, obviously, the number is more in the 400 million range now, but there's a lot of deals that are higher than that for the firms we represent, certainly. They also did a survey of serial acquirers, and they were showing them involved in nearly 500. So it's about 75% of all the transactions. So I'm not quite sure of the math because they're reporting on 492 reported transactions in the 3 years, less than 3 years. They're reporting on the January 20 to March 2023 period. So you got 2021, 22. It's a little over 3 years, actually. So in that period, there are nearly 500 deals, that about 75% of transactions being done by the serial acquirers. That's no surprise. There was a point at which we reported, I don't know, maybe about a year ago, 6 months ago, that DeVoe, one of the investment bankers in the space, was reporting that close to 90% of transactions were being done by these serial acquirers. I've seen those come down a little bit just because other people are getting into the market, and the serial acquirers have slowed down a little bit, but not, because they've sort of underwritten deals and become a little more conservative, although they're still doing plenty of deals. And so that's what Fidelity's reporting there. I guess the last thing I'll address is sort of just confidence or sentiment, or where I see and am hearing from not only my clients, but in the entrepreneurs organization community, amongst the investment bankers, amongst the people who provide financing, amongst entrepreneurs generally. And one of the beautiful things about this podcast is I've built so many relationships with amazing people when we do the guest interviews. I mean, we're approaching our episode 250, and 3 out of every 4 of those is with a guest. So we've had whatever it is, 175, probably with the ones I've recorded that I haven't released yet, close to 200 guests. So we get their input as well. The interesting part is I think I'm finding a lot of the folks in real estate on the commercial side, although they tend to be optimistic overall, there's been maybe more of a hit there overall. I feel like the folks on the corporate side are generally in a positive, optimistic mode. I mean, certainly when you speak to these serial acquirers, there's a sort of vested interest in saying, we're still doing deals. But in terms of sellers, I think because the numbers were so high in some of those areas, I think people are starting to adjust to the fact that they may not get that top dollar, but there's still nice deals out there. And I think although there's mixed signs on the economy, I don't think that things have been so horribly bad across most sectors. A lot of entrepreneurs are generally optimistic, and I think that flows into the deal market. Maybe we'll call it cautious optimism, right? They're watching out. And, like in any market, there's folks that are really looking for opportunities because they see it here. There are folks that are being more cautious. But those are some of the statistics that we've seen in the various articles. They pretty much track with what we've seen. But, again, it's interesting. We mentioned AI, but there are other areas that that are still, getting funding. We talked about during the pandemic how logistics companies, how various tech companies, how a lot of healthcare companies, whatever, did very well, and not only in terms of organic growth, but also in terms of deals. So there's always opportunities out there. I'm personally looking at some opportunities. I'm especially interested in some of my folks who are really focused on the real estate space to see, whether they're because I think there's going to be some opportunities there. So, but it'll be interesting to see what the second half of the year holds. I mean, we've got some, like I said, the stock market seems to be, getting a little stronger. The job markets, remain strong. The Fed slowed their interest rate rises, although there seems to be a thought that they're going to do one or two more. So inflation has come down a significant amount. So I'm also cautiously optimistic about what's going on here. We saw personally, at our firm, we were crazy busy the last couple of years. The first quarter, we had deals going on, but it was comparatively slower. But things picked up for us a lot in the second quarter. We had a lot of new deals that came in. Now, I'm not saying that we are any kind of microcosm of the entire deal market, or even the financial services and tech space where we play a lot. But we've seen deals in those spaces continue. We got deals in with our clients in entertainment related spaces, in logistic related spaces, in several other spaces beyond the financial services and tech world as well. So it'll be interesting to see what happens in this second half of the year. I don't think it's going to get blockbusters again like it was the last couple of years, but I do think it's going to be a solid year, and I think hopefully we'll be on an upswing from them, pending there not being anything crazy that happens in the world. So folks, that's the first half of the year, or a general recap of where we are, I think we are, and where some of the folks are reporting in various of the areas of some of the areas of the deal market. I would love when this episode posts for you to give me your thoughts, what sectors you're in, what you're seeing. Certainly I'm open to, gathering some input from other folks in terms of what they're seeing. I love to be up on the different markets and happy to report on them if you give me some information that I haven't seen yet. So with that, I'm going to conclude this solo cast. And next week, check us out with great upcoming guests for the next 3. Take care.
Thank you for joining me on this episode of DealQuest, where we help you understand how deal-driven growth can be your ticket to freedom. I want to invite you to a unique way to tap into the wisdom and experience of the DealQuest community. Join the DealQuest Deal Den Zoom calls, a free monthly 90-minute mastermind. In the mastermind, we address all the challenges you may be facing and help support you with the opportunities that may arise in terms of deal-driven growth. You will get input not only from me, but all the members on the call will collaborate and serve each other in a mastermind format. To sign up for the free mastermind, go to www.corykupfer.com/dealden. That's corykupfer.com/dealden. I'll see you there. I'm Corey Kupfer. Until next week, wishing you the freedom and financial prosperity that I know your DealQuest will bring.